All right, we're live, and it is Monday afternoon, December the 13th, and we're looking at a chart of Tesla to get started. Significant because we closed below 1,000. You can see there's these two sell bars on previous days last week, and today we closed under it. It's also significant because there's a large put position in Tesla, so this could be significant. This could be a big start of a big move down in Tesla. Moving over to the S&P, I almost sold the top last night. I had orders in, but I was planning for a retest of the all-time high, which is back at 47.40 in the continuous contract. Didn't quite tag that, and so I didn't get filled, but it was a bearish day. Price action, there was a lot of difficulty really recovering much from what I see as an impulsive selling wave down. And then much of the day we spent kind of going sideways. There wasn't a lot of recovery. So that's a bearish pattern. That being said, I don't see this as a particularly good setup for going short at this point. Not at this exact juncture. A lot of uncertainty in front of the Fed meeting too. So, I would say you're kind of flipping the coin, maybe more than usual, trading into a Fed meeting. But it is significant that the price level above 47.10 got rejected again. And the question now is, do we stay below the 50-hour moving average? So I would see resistance tomorrow at 46.95. We're very close to the so-called volatility trigger that Spot Gamma puts out. That's down at 46.60. And I have this 46.70 line that I've had in there for quite some time that's acted as support all the way back into mid-November, support resistance. And we're back there again. So we'll kind of see what happens. I think there's a battle between 46.70 and 46.95. I don't see a trade here for now myself. Crude had a little bit of relative strength today relative to the S&P. You know that I track that ratio, and I would expect that to continue and to strengthen. There was really nothing to write home about today, but this retrace really is overdue. Since crude is the more volatile of the two series, I would expect to see it through a crude rally, but yeah, I'm not holding my breath. I do think it'll start sooner than later, but you never know. Lastly, natural gas, we had a big reversal on heavy volume in the second half of the day today. That is significant. It was a really impressively bearish day. However, the internals of the day in terms of volume are lined up bullishly. So I don't think there's a trade here. So no trades today. And this actually gets back to my last video. In addition to not really feeling that there was a trade based on analysis, I had to really assess my energetics level as, an 8, but I woke up at like a 6. So today wasn't the day to make a decision, wasn't the day to be involved. It was the day to just grind at my day job, be really productive over there, do my energy practices, early this morning so I could come back tomorrow with a higher level of energetics. So let me just review quickly the lessons I came to over the weekend. And then I promise to go into an analysis of doing what has been working for me. But let me just review the lessons that I came to over the weekend. Practically speaking, I don't hold positions overnight often. Why is that? Because basically I really need to recharge at night. So most nights I need to go to bed flat. I define that as not more than 3 times in 2 weeks that I'd have a position. And the only time that I'd have a trade 2 nights in a row is if the trade is playing with house money, meaning I'd already taken profits on a portion of the trade that if you're trading with options, you can basically create it so that the original premium has already been recovered and no net loss on the trade is possible. Obviously, you can lose money from where that is. So in some sense, it's a red herring, but that's the rule I came up with. On average, shooting for 3 trades in 2 weeks. That's kind of the money zone. I'm shooting 1 to 2 trades a week. That's number 2. Number 3, going all out on the analysis, but not having it default to a trade. just because I did a bunch of analysis. Number 4, this is more common every day. There's absolutely an amazing opportunity every day in the market. But to see it, I have to be at a very high level of energy and vibration. I really believe that. And finally, stand guard at my mind. Always keep positive energy and vibration, and excavate negative energy through practices whenever necessary. So excavate negative energy doesn't mean if somebody gives me negative energy that I need to excavate it. It means if somebody gives me negative energy, particularly around this topic, and it triggers something in me, some sort of belief system or some sort of internal negativity, then I have to excavate that, if that makes sense. So those are the rules that I came up with. And now let's move on. I promised a little bit of talking about mimicking past successes. And what I found, first of all, I'll say the market is constantly changing. And so what worked as a success in one environment will not work in another. But what's working right now, what's working recently, right? If we looked at this algorithmically, is my entrances have been, for the wildly successful trades, have either been on an absolute extreme within an extreme, meaning something was ridiculously overbought or ridiculously oversold. That's not enough. There has to be an even more ridiculous short-term move within that ridiculous market context. And the example I would give would be crude oil selling off $10 in a day creates a ridiculous situation or context. Crude oil then selling off an additional $3 in whatever it was back here on the 2nd of December. Let's zoom in on a 15-minute chart and just go back there. The 2nd of December is right. This guy makes me dizzy too. 2nd of December is right here. Okay, so it sold off $3 in, let's just call it 30 minutes. Okay, that was a ridiculous move within a ridiculously oversold situation. So that's one context. The other context is if there's a, let's call super obvious reversal bar, like today in the S&P, okay, a reversal bar down today in the S&P. Waiting until you almost feel like the analysis is wrong and that the bearish, in this case, the bearish case has been invalidated. So what would that mean? Here it would mean probably getting up to like 47.05, maybe closing above the 50-hour moving average, right? Both of those scenarios would be cases where you'd start saying, okay, this bearish case does not look good. So it's right as you start to question. So right now, my stance would be bearish. I'd be looking for a place to sell or a place to buy puts. And my best entry in a situation like this would come just as I was about to throw in the towel in that view. Okay. Well, that's funny. And then the other attribute that I've noticed is that I tended to sell off 33 to 40% of the position as soon as I could pay for the whole trade. Remember, I'm trading with options, which means there's premium, which means I can sell off a portion of the premium, and let's say it triples, the position's value triples. I could then sell a third of it and pay for the original premium. Okay, and then, as I said before, in some sense, you can't lose on the net of the trade. Obviously, you can lose from that point. Okay, you can lose a lot from that point, but you can't lose from the net. And so somehow psychologically, that just puts me in a position to make better decisions. It also, obviously keeps the delta size more reasonable. You're still going to have an increased delta. So in some sense, you're pyramiding, but it's a reduction of the pyramiding. So you're squaring the delta to some extent. And so that I think is appropriate from a volatility management standpoint. So it's already a good practice. Okay, but then having a fairly aggressive target and exiting on a limit. So those are the characteristics of the exit of the super profitable trades. All right, that's all for today. I hope you enjoyed. I love making these videos, and I hope it brings value to you. All right, cheers.